In this video, you're going to learn how to squeeze more profit out of your winning trades. It's been my experience that knowing when to get into a trade is fairly obvious. It's right at support or just broke through a key level. On the other hand, knowing when to sell is much more difficult. How often have you set your profit at 2 to 1, it hits your target, only to see price continue higher and higher, and suddenly your 2 to 1 doesn't look so hot anymore. Take this trade on GNRC for example. We get a pullback to a key fib level. Looks like we have support. We set a buy stop if price comes back into the gap. Stop below the lows and take profit at 2 to 1. Here we're triggered into the trade. Price dances around for a bit, break even, eventually hits our target. It's natural to move on to the next trade, but what if we had a method to trail our stop in case price really starts to run? Stepping back and look at the big picture, how does 2 to 1 look now compared to 52 to 1? In this video, you're going to learn 4 ways to ride the trend to bigger profit. It's been said there are limits that protect you and there are limits that imprison you. You must protect the borders that protect you and destroy the borders that hinder your progress. From a trading perspective, I rewrite it and say, there are stop losses that protect you, and there are take profits that hinder your progress. If you've seen any of my other videos, you know I'm a vocal preacher of using a stop loss. In fact, my most popular video to date goes over 3 factors to take into account when setting your initial stop. You're doing yourself a disservice if your initial stop is in the wrong place and it keeps getting hit. You're not going to have a chance to trail your stop. So if you missed that video, go watch it now and then come back. Now that you have a solid foundation, we're going to build on it with 4 ways to lock in profit. Make sure you stick around to the end of the video where I offered a back test for you. Before we get started, to put it in context how powerful trailing your profits can be, I want to tell you one of my favorite trading stories of all time. Richard Dennis was a person who went against the grain. After college, he skipped graduate school and borrowed $1,600 from his family. He paid $1,200 in membership fees and was left with $400 to trade. In a short time, he became a millionaire and made $350 million within 6 years. Now, lots of people have made massive amounts of money trading, but that's not what Richard's known for. For years, there was always the debate of nature versus nurture. Are rock star traders successful because they're born with exceptional intelligence and just an innate ability to see the market? This is the view Richard's partner had. He thought they were a special breed. Richard was convinced of the opposite. He believed anyone can become a successful trader. Dennis used a trend following system where he trailed his stops as far as the market would take him. And he was certain he could turn the average American with no experience into $1 million trader. In order to settle the debate with his business partner, Richard ran recruiting ads in the newspaper between 1983 and 1984. He'd teach them and then they would trade with his own money and split the profits. For this financial experiment, Dennis selected a couple dozen men and women from a wide range of backgrounds. There was a security guard, a bartender, a waiter, an accounting assistant, a kitchen worker, a salesperson, a teacher, a geologist. Richard taught them for 2 weeks and then funded them each $1 million. Using his trailing stop strategy, many of his students profited 100% per year for 4 years. Richard once wrote, "Even though I was the only one who thought it was teachable beyond my wildest imagination." Toward the end of the video, we'll circle back to Richard and go over some of the key takeaways when using a trend following strategy. For now, let's go beyond the static 2 to 1 and talk about 4 ways you can trail your stop. Here we have Tesla. Obviously, this is an uptrend as price moves from bottom left to top right. But if I asked you what specifically makes this chart bullish, what could you point to? One of the hallmark features of an uptrend is higher lows. If your stop were below the recent low, you could have rode the trend all the way. Eventually, every trend ends, and one of the most obvious signs is when a recent low is no longer protected. Here our stop got taken out, and what do you notice? Soon after this, Tesla has been moving lower and lower. We can visualize these lows by using the Williams fractal indicator with a period of 5 or 6 for long-term trends. Here we get a bounce off a fib level and we have a new fractal. Like we talked about before, we don't want to go long right away. Look for the second fractal as confirmation of a higher low. We now have what would be the start of an uptrend. One way to trade this is to set a buy stop if price makes a new high. Stop will go below the tip of the arrow. We're not going to set a take profit. Instead, we're going to trail our stop and see how far the market wants to take us. The nice thing about fractals is there's no guesswork. You see a new arrow and you adjust your stop loss. That's all there is to it. Here you can see the original risk was $10, and we've already moved the stop 75% of the way to break even. We keep moving our stop as the trade moves. Eventually we got stopped out here for what turned out to be a 2.7 to 1 reward. One thing to keep in mind, we booked 2.7 to 1, but this trade actually went for a maximum of 4 to 1. Think about how a trailing stop works. As long as price continues moving higher, you're still in the trade. It's only when price comes back down that your stop is hit. So by very definition, we are never going to take our profit at the very top of the market. Your unrealized open profit will always be more than what you actually book when the trade is closed. But that's to be expected. Some traders get so emotional they can't see any of their open profit being lost. If that's you, maybe a trailing stop isn't the right way to go. You could just do the 2.5 to 1 static, set it and forget it instead of watching the market's ups and downs. The second trailing method is going to use a different type of candlestick called Heikin Ashi. It attempts to eliminate a lot of the noise, and it does this by opening relative to the last candle instead of the actual price. So here you see each green candle opens at the midpoint between the open and the close of the last candle. And the same is true for the red candles. The two charts are exactly the same instrument. Both are 4-hour candles and both for the exact same time period. The only difference is the top are the regular candles and the bottom are Heikin Ashi. How often have you bought near the bottom? Everything is going well until you see a big red candle. You get shaken out only to find you were actually right and the trend continues on without you. Looking at the regular candles, we have green, red, green, red, green, red, green, red. Looking at the exact same prices in the Heikin Ashi format, what do you see? Green, 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 green. You're much less likely to get scared out or confused. Looking at the first two sections, we see an obvious uptrend followed by a retracement. Regular candles gave a total of 18 wrong signals here, compared with only 6 for Heikin Ashi. There were 7 sections where Heikin Ashi had a perfect record. Look how smooth the transition is. All green, all red, almost all green, all red, all green. I never use Heikin Ashi for entering a trade, but they're great for getting you out near the top. After the trade has been going in our favor, I'll switch to the candles and set my trailing stop to slightly below the low of 2 candles back. Here you can see at the opening of each candle, we readjust our stop loss. We keep riding the trend until we would have eventually got stopped out here. With the fractals and Heikin Ashi, you have to manually adjust your stop at the end of each candle. This isn't too bad if you trade the daily or even the 4-hour, but if you're someone who enters on the hourly or the 15-minute, it can be a lot to keep track of. The good thing about the next two indicators, you can just set an alert and forget about it. Autodesk has been a really strong stock over the years. It recently touched the 61 fib a couple times and looks to be supported. We can market buy and add the third indicator, which is the Chandelier exit. By default, ATR multiplier set to 3, which I think lags a little too much. Play around with the settings and notice how the lines move on the chart. I'm going to keep it at 2.3 for now. One thing I've seen people do that's a mistake is use the signals for both entry and exit. We're not going to buy here and sell here and rebuy here and short again. Especially in a choppy market, that's a sure way to not only get frustrated, but lose your money over the long run. Remember, a trailing stop only comes into play once you've already entered the position. Whether it's price action or indicators, you have a system for entering. The only thing we're talking about right now is how to trail your stops and exit. Replaying the trade, you see a sell signal, and that's where we would have exited. Price comes back down to support and we set a buy stop to trigger if price goes above the recent highs. Only after we're triggered into the trade that we turn the indicator back on. The trade runs and we got stopped out at the next sell signal. You wouldn't even have to micromanage the trade once you enter. Right click on the indicator and add an alert. Since we're long, we want to be notified the next time we get a sell signal on bar close. Until you get an email or text, you go about your day. You don't even have to think about it. The essence of a trailing stop is I'm not trying to guess where the top is. I'm going to make the market take me out and prove me wrong. When the trend is strong, 10 or 20 to 1 is possible. We've talked about trailing with ATR, Heikin Ashi, and fractals. Another common way to trail your stop is using a moving average. Just as a reminder, we're not going to use the moving average as an entry signal. In this case, we get a consolidation, higher high, higher low, setting a buy to get triggered if price breaks back up again. Only now is the time to go to indicators and search for custom moving. I'm sure you know the EMA is faster than the simple moving average, but you might be surprised to learn the EMA itself is actually pretty slow. Here's a list of common moving averages, and both EMA and SMA are towards the bottom. Now that we've entered, right-click, Add Alert. The first condition is whatever we're trading. Since we're long, we want to know when it crosses down the custom MA1 on bar close and turn on notifications. I tend to favor a faster moving average, but there are pros and cons to each. A faster moving average is good because you won't lose as much of your open profit. The flip side is it might be too quick. Price only retraces a little and the moving average overreacts by giving you a premature exit signal. You get out and price continues on without you, and you miss the meat of the move. Here the almost faster than the EMA. You can see how closely it hugged a price, and all it took was 2 red candles in a row. We would have been out of the trade. This can be a good thing if the trend is actually over, but it might also be bad if price was just pausing and you don't have a way to get back into the trade. On the other hand, if you tend to only take one shot and then move on to a different stock or forex pair, it might be better to use a slower moving average. You won't get out as close to the peak, but at least you'll lock in a majority of the move. Price closed below the EMA on the last candle, so if you like the EMA, that's where you'd exit. TMA lags behind the other two, but in this case, it creates a buffer to keep us in the trade longer. Depending on which moving average you pick, your R to R would have been anywhere from 0.35 up to almost 3 to 1. Now, I want to show you a way to use moving averages to potentially trail your stop even further. Before, we got an alert that price closed below the average and we exited right away. What we're going to do now is when we get the alert, we're going to move our stop to just below the recent candle and wait until we either get taken out or price moves higher and we get another alert. Here's our first signal on ALMA. Before we got out of the trade, now we're going to move the stop to just under the wick. We are risking a little more than before if price keeps going lower, but it may help us avoid a fake out. Price moves a little higher and we get another alert and adjust the stop. Next candle triggers our stop and we're automatically taken out at slightly more profit than the original trade. A few candles later was where the original EMA exit was. Instead, we move our stop up to see how things play out. Price finally closes below the EMA and we move our stop up. Readjust it one more time before actually exiting. Last trade is TMA and set the new stop with just a little breathing room. Readjust, and this time was slightly worse than our original exit. I'd say the strategy is pretty typical of what you'll see as you use this strategy more and more. Maybe 2 out of every 3 times, your exit will be slightly better or slightly worse. But on other trades, you ride a massive wave like Richard Dennis mentioned at the beginning of this video. Trading is a game of probabilities, and the way to know which indicator is better is to backtest them across different time frames, instruments, and market conditions. I want this channel to be as real world as possible. Because of this, I need your help. In the comments, let me know 3 things: the time frames you trade, favorite stocks or forex pairs, and the criteria you use for entering trades. Once I have a good data set of suggestions, I'll make that backtesting video for you. You'll be able to see which indicators in which market conditions are the most profitable. Trailing your stops instead of getting out at 2 to 1 is more profitable in the long run, but no system is perfect. And now I want to go over some of the negatives of using this method. Set your take profit at 2, 2.5, or 3x your stop loss. When you enter the trade, your stop loss and take profit are already entered with the broker. You don't even have to look at the chart. You'll get an alert when the trade is either a loser or you hit your full take profit. I stand by my method for 3 types of people: the newer trader who has less than 100 real money trades under his belt, the consistently losing trader, and especially the overly fearful and emotional trader. The biggest risk of manually trailing your stop is the human factor. Problem number 1 is not trusting the system. You have an alert set, but you're curious and you want to see how things are going. You're in profit, things are going well, but you notice more and more red candles, and the red candles are even larger than the recent green ones. Price is almost at the moving average, so you might get nervous and just take your profit, but miss out on a good chunk of the move. Number 2 is the opposite. Instead of getting out too early, you get out too late, or not even at all. These are 15-minute candles, and you've been happily riding the trend for a while. You get notified on this candle, but you're at lunch with a friend, taking a nap, or you're at work and you just can't get away. This system is designed for you to react on the next candle, either by exiting or trailing your stop close to the candle. If that's something that doesn't work with your lifestyle or schedule, then a fixed 2.5 to 1, set it and forget about it, might be better for you. Number 3 is what I call having a selective memory. It's convenient to forget about all the times the trend worked in your favor and only remember the trades when the moving average did worse. Here we have some higher lows and decide to go long again. Before, you may have set your take profit at 2.5 to 1 and happy days when you cash out. This same trade using a moving average wouldn't have worked out so well. Price quickly reverses and you're back to break even. No system is perfect, but we want to maximize our profit over the long run. And the way to do that is by trailing our stops. So 2 homework assignments for you. First, comment down below what and how you trade so I can backtest using a trailing stop. The second is to watch the video about setting the best initial stop loss you can. Click the video here, and I'll talk to you soon.